When you check into a Hilton Hotel, build with Legos at Legoland, or trace your family history on Ancestry.com, you might not realize you're experiencing the hidden empire of a single financial giant. All three companies, along with hundreds of others, are owned by Blackstone, the world's largest private equity firm. This invisible web of ownership represents one of the most powerful forces reshaping the global economy. Yet most people have no idea how it actually works. Private equity has quietly become the puppet master pulling strings across nearly every industry, from the hotels where we sleep to the companies where we work. These financial titans manage trillions of dollars, turning modest investments into billion-dollar empires, while fundamentally altering how businesses operate. Understanding private equity isn't just about finance, it's about understanding who really controls the modern economy. At its core, private equity represents a different approach to business ownership and growth. When companies need capital to expand rapidly, they face two primary options. They can sell shares to the public through stock markets, or they can turn to private investors. Private equity represents the latter path, but with a crucial twist that separates it from traditional investment. Unlike public shareholders who might hold stocks for years or even decades, private equity firms operate with a fundamentally different timeline and strategy. They purchase companies not to hold them indefinitely, but to improve them systematically and sell them at a significant profit within a specific time frame, typically 5 to 10 years. This approach creates an entirely different dynamic in how businesses are managed and grown. The private equity model operates through 4 distinct phases that have become the industry standard. First, firms raise capital from outside investors, pension funds, university endowments, wealthy individuals, and even governments, pooling this money into specialized investment funds. Second, they identify and acquire target companies, often using a combination of investor capital and borrowed money. Third, they implement operational improvements designed to increase profitability, which might include bringing in new leadership, restructuring operations, expanding into new markets, or improving marketing and branding. Finally, they execute an exit strategy, selling the improved company through an initial public offering, to another company, or to another private equity firm. The roots of private equity stretch back over a century, though the industry has evolved dramatically from its early incarnations. In the early 1900s, business magnates like J.P. Morgan, the Rockefellers, and the Vanderbilts were already using investor capital to purchase companies, but their strategy differed significantly from today's approach. Rather than flipping companies for quick profits, these early titans bought multiple companies within the same industry, merged them into massive corporations, and used these consolidated entities to build lasting business empires. The modern private equity model began taking shape after World War II, when the booming post-war economy and the return of hundreds of thousands of veterans created unprecedented opportunities for new businesses. Harvard professor George Doriot recognized this potential and created the American Research and Development Corporation, ARDC, in 1946, widely considered the first true venture capital firm. Doriot's most famous investment perfectly illustrates the explosive potential of private equity. ARDC invested just $70,000 in a small company called Digital Equipment Corporation, DEC, and when DEC went public in 1968, that investment had grown to an astounding $355 million. This success story established the template for modern private equity, proving that sophisticated investors could identify promising companies before they achieved mainstream success and generate extraordinary returns through strategic support and timing. By the 1980s, the industry had evolved again, shifting focus from backing new ventures to acquiring existing companies and making them more profitable through operational improvements. The transformation continued through the 1990s and early 2000s as private equity became increasingly mainstream. No longer limited to billionaire investors, the industry began attracting capital from pension funds, university endowments, and government entities seeking higher returns than traditional investments could provide. The 2008 financial crisis prompted another evolution, as tighter regulations pushed firms to focus more on operational improvements and technological upgrades rather than simply cutting costs. Modern private equity firms employ 4 primary strategies, each with distinct risk profiles and potential returns. Understanding these approaches reveals how different types of deals create wealth and reshape industries. First is the leveraged buyouts, LBOs, represent the most well-known and controversial private equity strategy. These deals involve purchasing companies using a combination of investor capital and borrowed money, with the acquired company's own assets serving as collateral for the debt. J.P. Morgan's 1901 acquisition of Carnegie Steel is considered the first major leveraged buyout, but modern LBOs have refined this approach into a sophisticated financial instrument. The mechanics of an LBO reveal why this strategy can be so profitable. When a private equity firm wants to acquire a company worth $10 billion, they might contribute only $2.3 billion of their own capital, while borrowing the remaining $7.8 billion. The acquired company's assets back this debt, and its future earnings service the loan payments. This leverage amplifies potential returns dramatically. If the firm sells the company for $15 billion 5 years later, their $2.3 billion investment has generated a $5 billion profit, representing a return of 150 to 250%, rather than the 50% they would have earned without leverage. Blackstone's acquisition of Hilton Hotels demonstrates how successful LBOs operate. In 2007, Blackstone purchased Hilton for $26 billion, immediately appointing new leadership and shifting the company's focus from real estate ownership to brand management and franchising. Crucially, they injected $800 million of additional capital to strengthen the company's financial position, enabling larger loans for renovations, marketing, and expansion. When Hilton returned to public markets in 2013, Blackstone began gradually selling their stake, ultimately exiting the investment in 2018 with approximately $14 billion in profits over 11 years. However, not all LBOs succeed. The Toys R Us bankruptcy illustrates how leverage can destroy companies when not managed properly. In 2005, multiple private equity firms acquired Toys R Us for $6.6 billion, loading the company with debt but failing to inject additional capital for improvements. Instead, the firms collected over $470 million in fees and interest payments between 2005 and 2017, while the companies struggled under massive debt burdens. Without resources to modernize stores or develop e-commerce capabilities, Toys R Us fell behind competitors and eventually filed for bankruptcy in 2017, closing over 800 stores and eliminating thousands of jobs. Second is the growth equity, which represents a more conservative approach, focusing on established, profitable companies that need capital to scale operations, enter new markets, or develop new products. Unlike LBOs, growth equity deals typically use little or no debt, with private equity firms usually purchasing minority stakes rather than taking full control. This strategy powered TikTok's global expansion, as firms General Atlantic and KKR invested in Buyouts, TikTok's parent company, providing the resources necessary for rapid international scaling. Thirdly, we have the venture capital, which occupies the highest risk, highest reward segment of private equity, involving investments in small, unproven startups with the potential to become billion-dollar companies. Venture capitalists bet on innovative ideas and early-stage companies before they've proven their business models. Success stories like Sequoia Capital's early investments in Airm, Google, and WhatsApp demonstrate the extraordinary returns possible when these bets paid off. However, failures are common in total, as demonstrated by Sequoia's $214 million loss when cryptocurrency exchange FTX collapsed, or the $700 million venture capital investment in Theranos that became worthless when the technology was revealed as fraudulent. Lastly is the distressed investing, which involves purchasing struggling or bankrupt companies at significant discounts, then attempting to turn them around for profit. Sometimes this creates genuine value, as when Apax Partners acquired Game UK and increased its market value 12-fold through restructuring. However, distressed investing can also involve aggressive cost-cutting and asset sales that leave companies worse off than before, as seen in numerous bankruptcies where private equity-backed companies fail to recover. How private equity creates wealth. The financial structure of private equity deals reveals why this industry has created so many billionaires and built massive financial empires. From a single acquisition, private equity firms create multiple income streams while minimizing their own financial exposure and maximizing potential returns. The fee structure provides immediate and ongoing revenue regardless of deal performance. Management fees, typically 2% of total assets under management, generate steady income throughout the investment period. On a $1 billion fund, this represents $20 million annually in management fees alone. Performance fees, usually 20% of profits, create additional upside when deals succeed. These fees ensure that even struggling investments generate significant revenue for the firm. Leverage amplifies returns by reducing the firm's actual capital contribution, while maintaining full ownership benefits. When a firm contributes only 20% of an acquisition's purchase price, while borrowing the remaining 80%, successful exits can generate returns of 1,000% on invested capital, rather than the 100 to 200% returns typical of all cash transactions. The debt structure provides additional advantages beyond leverage. Interest payments on acquisition debt are tax-deductible, allowing companies to retain more earnings. Since the acquired company, not the private equity firm, is responsible for debt repayment, the firm's downside risk is limited to their initial equity investment. Exit timing and strategy optimization ensure maximum returns when firms sell their investments. Rather than simply accepting the highest offer, private equity firms analyze market conditions, strategic alternatives, and timing to maximize sale proceeds. They might take companies public during favorable market conditions, sell to strategic acquirers willing to pay premium prices, or flip investments to other private equity firms for additional restructuring. This combination of multiple revenue streams, leverage, tax advantages, and strategic exit planning explains how firms like Blackstone, KKR, and Apollo have grown to manage trillions of dollars while generating extraordinary returns for their founders and investors. Private equity's influence continues expanding across industries and geographies, with firms increasingly involved in technology, healthcare, infrastructure, and real estate. As traditional investment returns remain low, more institutional investors are allocating larger portions of their portfolios to private equity, providing firms with ever larger pools of capital to deploy. This growth raises important questions about economic concentration and corporate governance. As private equity firms acquire larger stakes in essential industries, their decisions affect millions of workers, consumers, and communities. The industry's focus on operational efficiency and financial returns can drive innovation and growth, but it can also lead to job losses, reduced competition, and short-term thinking that prioritizes quick profits over long-term sustainability. Understanding private equity's mechanics and motivations becomes increasingly important as these firms shape more aspects of daily economic life. Whether viewed as efficient capital allocators driving business improvement or as financial engineers prioritizing profits over broader stakeholder interests, private equity firms have become among the most powerful players in the global economy. The next time you encounter a familiar brand or service, consider the possibility that a private equity firm may be the true owner, making strategic decisions designed to maximize returns on their carefully structured investments. This hidden layer of ownership and control represents one of the most significant but least understood forces shaping modern business, making private equity literacy essential for anyone seeking to understand how the contemporary economy really operates. Thanks for watching. Support our channel by hitting the like and subscribe button.